Hello everyone, I am Kushagra Garg from the Bachelor's of Business Administration Department of Design Ecole College. Today I am going to present my topic on company law, corporate formation, governments, and capital market. A company is an artificial legal person created by law. It has its own identity, which is completely separate from its owners and shareholders. Under the Companies Act 2013, companies are legally allowed to own property, enter into contracts, and take legal action in their own name. Companies play a very important role in economic development by creating employment opportunities, encouraging innovation, and supporting industrial growth. Company law helps us explain the rights, duties, and responsibilities of director, stakeholders, and management. This ensures a smooth functioning of companies and protects the interest of all shareholders. A company has several important characteristics. First, it has a separate legal entity, meaning the company is different from its owner or members. Second, it has legal standing, so it can be sued or can sue in its own name. Third, companies have a strong economic impact by contributing to growth and job creation. Additionally, members enjoy limited liability. The company is an artificial person and it acts officially through common seal. Types of companies and importance of classification. Company can be classified into different types. A public company can invite the general public to buy shares and debentures. A private company restricts transfer of shares and cannot raise funds from the public. A one-person company or OPC is owned by a single individual with limited liability. A government company is one where at least 51% ownership is held by the government. Classification is important because it defines ownership and control, ensures proper legal compliance, and limits the liability of members. Example, Tata Steel, Swiggy, Arna Software OPC, and Bail. Corporate formation. Corporate formation is a legal process through which a company is brought into existence under the Companies Act 2013. Through this process, a company obtains a separate legal identity and official recognition. After this formation, a company gains the right to enter into contracts, own properties, raise capital, and conduct business legally. Corporate formation also ensures limited liability, continuity of business, and legal protection for its members. An example of corporate formation is Infosys. Steps in corporate formation. There are four important steps in corporate formation. The first step is promotion, where the business ideas is conceptualized and documents are prepared. The second step is incorporation, when the company is registered with the registrar of the companies. The third step is obtaining the certificate of incorporation, which confirms the company's legal existence. Finally, after completing required fulfillment formalities, the company begins business operation. Corporate governance and principles. Corporate governance refers to the system by which a company is directed and controlled. It ensures transparency, accountability, and ethical management within an organization. The key principles of corporate governance include trust building, transparency, accountability, fairness, and responsibility. Good corporate governance improves company reputation and builds investors' confidence. The Tata Group is a well known example of strong corporate governance in India. Capital market and types. The capital market is a financial market where long term funds are raised and invested. Companies raise capital through shares, debentures, and bonds. There are two types of capital market. First, the primary market deals with the new issue such as IPOs. Second, the secondary market, which allows investors to trade existing securities and provide liquidity. Role of SEBI. SEBI stands for Securities and Exchange Board of India. It was established in 1988 and given statutory powers in 1992. SEBI protects investors' interest, prevents insider trading, ensures transparency, and promote fair practices in the market. Method of raising capital. Different type of companies use different method to raise capital based on the size of ownership and legal structure. Public company raises a large amount of funds from the general public. They use methods such as IPO or initial public offering, where shares are issued to the public for the first time, and further public offering or FPO, where additional shares are issued after listing. They also raise funds through right issue, bonus shares, and debentures, which are long-term debt instrument. carrying fixed interest. Private company cannot invite the general public to invest, so they rely on private placement, where shares are offered to selected investors. They also raise funds through angel investors, venture capital, and by reinvesting their profits, known as internal accruals. One person company or OPC have limited options. They mainly depend on their owners for personal capital, bank loans, and financial support under various government MSME schemes. Government company raise capital through government funding, public issue of shares, bonds, and debentures, and budgetary support, especially for strategic and infrastructure projects. Conclusion. To conclude, company law provides a strong legal framework for forming and managing companies. Corporate formation gives legal identity, corporate governance ensures ethical management, and SEBI protects investors. Capital market helps companies raise long-term funds for growth. Understanding these concepts helps business operate legally and achieve sustainable success. Thank you.